Welcome to the Deep Dive. We're here to break down complex topics, get you informed quickly. Today we are diving into semiconductors, specifically Navitas Semiconductor. We'll look at their recent earnings, their business model, and maybe figure out where they're headed. They seem to be at a really interesting point right now, and we've got a lot to work with for this deep dive. We have Navitas' actual Q2 2025 results, a bunch of analyst reports, their own business model breakdown,
Yeah.
and even a big semiconductor outlook from Deloitte. So, yeah, plenty to give you the full picture.
Right. And our goal today really is to unpack the Navitas story, look at the potential, which is exciting, but also the challenges they're facing right now. So by the end, you should have a good, solid understanding of where they are and where they might be going in this pretty crazy semiconductor market.
Okay, before we get right into Navitas, let's zoom out a bit, because the whole semiconductor industry is just, it's massive right now. It's not just growing. Deloitte thinks 2025 sales will hit nearly $700 billion, a record. And get this, they see it hitting $1 trillion by 2030, maybe even $2 trillion by 2040. That's like a 7.5% growth rate every year. It's huge.
It is huge, but what's interesting is how uneven that growth is. If you look at the top 10 chip companies, their market cap jumped, 93% by the end of last year? But a lot of that, especially going into 2025, is really being driven by generative AI chips. That market alone might top $150 billion this year. So yeah, it's a gold rush, but definitely concentrated in specific spots.
And speaking of specific spots, that brings us to these newer materials, right? Gallium, nitride, GaN, and silicon carbide. So could see everyone seems to be talking about them. They're supposed to be way more efficient than traditional silicon. Why are they suddenly such a big deal?
That's exactly. Well, suddenly is relative, but yeah, they offer much better performance than the old silicon MOSFETs. Those are the basic switches in electronics, especially for handling power and high frequencies. Silicon just kind of runs out of steam there, and the projections show it. The scanner market growing steadily, maybe $5.8 billion by 2032. That's about 7.5% a year. But Canon, it's currently smaller, maybe $2.6 billion now, but it's projected to hit $16.6 billion by 2032. That's almost 23% growth per year. That huge difference tells you where a lot of the excitement's building.
Wow. Okay, 23% versus 7.5%. That is a big difference. And it's because they're more efficient, handle more power in smaller sizes. You mentioned miniaturization. I guess those super fast phone chargers are a good example.
Perfect example. Chances are, if you have a really small fast charger,
Mm-hmm.
it's using GaN or maybe Sikh-Canasi.
Right. I remember those old laptop power bricks. Massive thing.
Exactly. So GaN and Sikh allow things to be much smaller, lighter, waste less energy as heat. It enables totally new designs, not just in chargers, but everywhere.
Okay, so with that context, this booming but uneven market, with these new materials playing a key role, let's focus on Navitas Semiconductor. They call themselves the only pure-play, next-gen power semiconductor company, leading in GaN and CC with their GaNFast and GeneSiC tech. Sounds impressive, but what's the core pitch? What makes their tech attractive to, say, other businesses?
Well, their value proposition ties right back to that efficiency and size thing. Navitas says their GaN ICs are up to 40% more efficient, 3 times the power density, and switch up to 10 times faster than silicon. What that means practically is components can be like 70% smaller and lighter, and the energy savings are significant, up to 50% less energy loss in chargers, potentially 20% less power used in data centers.
Okay, 20% in a data center, that's not trivial at all. That's massive savings on power and cooling.
Absolutely. It's a big deal for those large-scale operations. Reduces heat, allows more servers in the same space, cuts operating costs.
And their business model helps them focus on this innovation, right? They're fabless.
Right. Fabless means they design the chips. That's their core expertise. But they don't own the factories, the fabs, that actually manufacture them.
They contract that out.
Exactly.
Yeah.
Manufacturing, assembly, testing, it's all outsourced. It keeps their capital spending really low so they can pour resources into R&D and design.
Does that make them more vulnerable if there are supply chain hiccups? Or does it give them flexibility?
It's a bit of both, really. It lets them partner widely, which is a strength. They work with big manufacturers like STMicro and TI for production, so they get access to top-tier manufacturing without the huge cost. And on the design side, they've worked with car companies like Hyundai, BMW, tech firms like Apple, Dell, getting their tech into key products. Plus, they license their technology to others like Qualcomm and NXP. That brings in millions. And they protect all this with, I think, over 150 patents granted, more pending. And here's
Wow.
something pretty unique. They offer a 20-year warranty on their GaNFast tech.
20 years for a
Yeah.
semiconductor. That's unusual.
It's almost unheard of. It really shows their confidence in the tech's reliability, like offering a 20-year engine warranty when everyone else does 5.
Okay, that's a strong statement. So knowing all that, how are they actually doing financially? Let's look at the latest numbers. They announced Q2 2025 results on August 4th. The headline wasn't great. Revenue was $14.5 million. That's down 29% from last year, and it missed expectations. The stock dropped almost 16% right away. What happened there?
Yeah, digging into it, their gross margin also fell quite a bit, down to 16% from 39% the year before. So less profit on what they did sell. The main reason for the sales drop seems to be softness in mobile and industrial markets, especially in China. So yeah, headwinds from the global economy, maybe some saturation in consumer electronics. It shows even cool tech isn't immune to market cycles.
And it looks like they reacted by cutting costs pretty aggressively. Operating expenses down 39% year over year. They had that workforce reduction 19% back in January. R&D spending down 39%, SG&A down 50%. I mean, they're really trimming things back.
They are definitely tightening the belt, which you'd expect given the revenue drop.
But wait, if they cut costs so much, why did their net loss get wider? It went from about negative $22 million last year to negative $49 million this quarter. How does that work?
Yeah, that's the interesting, slightly confusing part. Despite the cost cuts, the reported loss increased. A big chunk of that increase, about $28 million, was actually a non-cash loss. It's related to something called earn-out liabilities. Basically, when they bought another company, they agreed to pay more later if Navitas' stock did well.
Okay.
And their stock did go up from like $1.50 to over $3. So the estimated future value of that payment, which counts as a liability on their books, went up. That created this larger paper loss, even though no extra cash actually went out the door this quarter. It's an accounting thing.
Huh. Okay, that makes more sense. An accounting loss, not a cash loss. And speaking of cash, it looks like their cash position is actually pretty strong. They raised $100 million.
Right. They did 2 at-the-market offerings. That boosted their cash to over $161 million. Plus, they have no long-term debt, and their operating cash burn actually improved. So they have a decent runway.
That cash buffer must be crucial right now, especially if they're planning a shift.
Absolutely crucial. It gives them breathing room to execute their strategy without immediate financial pressure. But there were a couple other flags in the Q2 report worth mentioning. One is customer concentration. A single distributor made up 54% of their sales in Q2. That's pretty high. Makes them vulnerable.
Yeah, relying that much on one channel is risky.
And they also disclosed what are called material weaknesses in their internal financial controls. They have a plan to fix it by Q4, but it's something investors watch. Pretty common for growing companies, but still needs fixing.
Okay, so challenges, but also some financial stability. Now, let's talk about this strategic pivot. This sounds like the really big story. They're shifting focus hard towards AI data centers and energy infrastructure.
Exactly. This seems to be the core of their forward-looking strategy now. The CEO, Gene Sheridan, basically said they want to do for AI data centers what they did for mobile chargers, create a new market based on GaN and SiC. They're estimating these technologies could enable a, get this, 100x increase in server rack power capacity.
100 times? What does that even mean in practice?
It means you could pack vastly more computing power into the same physical data center space, which is exactly what AI needs: huge amounts of power, densely packed. They see this as a $2.6 billion market opportunity for their tech by 2030. It ties right back to that massive AI chip growth we talked about earlier.
That's a huge target, and they landed a major partner to help them get there. Nvidia.
Yes. Nvidia selected Navitas for a development collaboration, specifically for next-gen 800-volt data centers. This involves Navitas' GaN and 60 portfolio, covering multiple power stages from the big transformers down to powering the actual AI processors.
Working with Nvidia, that must be a massive validation for their technology, right? Especially in the AI space, does it sort of de-risk this big pivot?
Oh, absolutely. Nvidia is the name in AI hardware right now. Getting picked by them is huge validation. It signals that GaN and CT are likely essential for the power needs of future AI systems. It definitely de-risks the strategy by locking in a top-tier partner and showing the market this is serious.
And there's a timeline for this.
There is. Initial evaluations are done. They expect final engineering samples out by Q4 this year, 2025, then supplier selection, system designs in 2026, and volume production hopefully starting in 2027.
Okay, so it's a multi-year plan, not an overnight thing.
Definitely not. Patience is needed.
So what happens to their original business? The mobile chargers, consumer stuff, they're saying they'll focus more on the high-end premium parts of those markets.
Yeah, the idea is to kind of prune that business a bit, focus on higher margin products, reduce dependence on those more volatile segments. And that frees up resources, money, engineers to invest in the AI data center push.
Is that a smart move to sort of de-emphasize their current core business for this future bet?
It's probably a necessary gamble given where the massive growth seems to be, but it's not without risk, especially during the transition. And it connects to another pretty significant challenge they're facing on the supply side.
Oh, what's that?
Well, TSMC, the giant Taiwanese chip manufacturer who is currently their only supplier for GaN wafers, plans to stop making GaN by July 2027.
Their only supplier is quitting. That sounds bad.
It's a critical risk, yeah. They have to transition all their GaN production to someone else. They're working fast to qualify another supplier, PowerChip. They hope to have initial qualification done by Q4 this year, mass production in early 2026. They're also looking for other sources. But it's a huge undertaking, like changing engines mid-flight. Any delays or problems there could really hurt their plans.
Wow. Okay, so a major pivot and a critical supplier transition happening at the same time. That's a lot to manage.
It absolutely is.
And just entering these new markets, like AI data centers, must have its own unknowns.
Yeah.
Forecasting demand, new competitors popping up.
Exactly. There's no long history to base forecasts on. The competitive landscape could shift quickly. It's definitely an exciting frontier, but also a risky one.
How do analysts see this playing out, especially profitability?
Well, analysts see strong revenue growth ahead, projecting almost 22% a year, faster than the overall U.S. market. But they also expect Navitas to remain unprofitable for the next 3 years at least. So the stock's performance is probably going to hinge a lot on market confidence. Confidence that the growth in 2026 and beyond will materialize as that power chip transition happens and the AI strategy ramps up.
It's a bet on future execution then.
Very much so. A classic growth stock story. Jam tomorrow, not today.
And then there are the broader industry headaches, right? Talent shortages, geopolitical stuff.
Yeah, those are always in the background for semiconductor companies. Finding and keeping top engineering talent is super competitive. And things like export controls, tariffs, U.S.-China tensions, they can definitely impact global supply chains and market access. It adds another layer of complexity to Navitas's global operations and partnerships.
Okay, so let's try to wrap this up. What's the takeaway here? Navitas is clearly in a major transition, making a big, high-stakes bet on AI data centers and energy infrastructure. They've got innovation, key partnerships like Nvidia. They've cut costs, raised cash. That's the positive side.
Right. But on the other side, you have that Q2 revenue miss, the reliance on one big distributor, the critical TSMC supplier transition hanging over them, and the fact that profits still look a few years away, at best.
So the big question really is, can they pull off this pivot? Can they ramp up in AI data centers fast enough and smoothly enough, especially with the supplier change?
Exactly. Will the new growth engine kick in before the old one sputters too much? And can they navigate that gain in supply transition without a major hiccup? It's a race against time, really. Their execution on the Nvidia deal and the power chip ramp up will be critical things to watch.
So here's a final thought for you to consider. If Navitas is successful with this AI data center strategy, how might that success ripple outwards? Could it fundamentally change the game for power semiconductors, pushing GaN and SiC even faster into the mainstream beyond just Navitas' own success?